Hey guys, welcome back. In today's video, we are diving deep into the AMC 200X situation, including the fact that there are virtually no more shorts available, the implications of a $4.5 trillion margin call, and much more. Let's start by breaking down some of the information you probably haven't been told. When you hear about billions of microcap shares being traded or manipulated, the media rarely explains how this affects individual companies or stocks. This is why it's so important to understand the context behind what's happening with AMC. Essentially, what we are seeing is that the SEC has decided to drop certain matters without any admission of faults or penalties for either side. In simpler terms, this means that massive institutions, many of which have made hundreds of millions of dollars through these activities, are getting a free pass. And unfortunately, this isn't new. History has shown us this pattern time and time again. Take Goldman Sachs, for example. Despite being responsible for activities that generated hundreds of millions in profits, they were only fined $1 million. That's not a consequence, it's just the cost of doing business. This history of regulatory leniency is critical to understand because many people assume that because the SEC isn't taking immediate action against synthetics or naked short selling, it doesn't exist. That assumption is completely false. Regulatory bodies, including the SEC, have repeatedly allowed these institutions to operate with impunity, and this doesn't mean the problem has disappeared. Rather, it indicates that for now, there are no severe consequences. The SEC is essentially kicking the can down the road. Big firms like Citadel and Virtue, which have been shorting AMC for years, have yet to face real consequences, but this does not mean synthetic shares are gone. In fact, it means that when these firms are eventually forced to settle, the cost could be astronomical, potentially thousands of dollars per single share of AMC. To put this into perspective, consider what happened with AMC in 2021. The float was sold short over 20 times more than the authorized amount, 1 billion shares traded when only 15 million shares were actually available. And that's just back then. Fast forward 4.5 years later, and it's entirely possible that the float has been sold over 200 times, or even more. We've consistently reported on this, and it's critical to understand the sheer scale of the situation. Some projections even suggest that single shares could reach astronomical prices in the hundreds of thousands of dollars once the squeeze occurs. Every investor paying attention would understand how the repeated selling of AMC float contributes to this scenario. Another important point is that new synthetic shares of AMC are effectively being created every single day. This happens because the original float has been fully absorbed by retail investors who have not sold any of their shares. With no additional shares being issued, the only way liquidity continues is through rehypothecation, essentially the repeated lending and reselling of shares by short sellers. While we don't have an exact count of how many synthetic shares have been created over the years, the pattern is clear. Back in 2021, these practices were already well established, and they have continued in the years since. Some estimates suggest the number of synthetic shares could be 200 times, 2,000 times, or even higher than the actual float. This is also why the SEC has been hesitant to take direct action. If regulators forced short sellers to cover right now, it could potentially bankrupt multiple major institutions. Instead, they're hoping either that AMC fails or that retail investors sell out, allowing the problem to remain unresolved for a while longer. When the moment comes that the can cannot be kicked down the road any further, the squeeze will be inevitable, and the institutions responsible for creating billions of synthetic shares will be forced to pay, likely at astronomical prices per share. This is the core reason why so much concern surrounds AMC and similar stocks like GME. Interestingly, we've seen a glimpse of how serious this can be with cases like Genius Group, which recently filed a lawsuit against naked short selling. Immediately following this action, the number of shares available to borrow for Genius Group dropped to 0. This is a small-scale example compared to AMC, but it illustrates the power and effect of enforcing short covering. AMC and GME face similar issues, but on a much larger scale due to the volume of synthetic shares that exist. Even firms like Genius Group, with fewer synthetic shares to contend with, are seeing immediate pressure when they act. Now, imagine what happens when AMC or GME triggers the same scenario. The impact would be orders of magnitude larger. Another critical piece of evidence of the short's desperation is the drop in XRT borrow fees from 2.56% to 1.78%, leaving only 500 shares left to borrow. This is not a normal market condition. It's essentially a last gasp in a crowded short squeeze environment where institutions are scraping the bottom of the ETF barrel to find shares they can borrow. XRT and other similar ETFs have historically been used to short AMC and GME, and despite billions being pulled from these funds, shorts are still aggressively searching for shares. This desperation clearly demonstrates the pressure they are under to maintain their positions and suppress prices, using whatever tools are available, including tokenizations or ETF manipulations. Finally, all of this ties directly into margin lending. FA's margin loans were $784 billion as of March 31, 2024, but this doesn't include the additional $4.5 trillion in margin loans to hedge funds. This is an enormous sum, far beyond what is publicly reported, and highlights just how much leverage is circulating in the market. While not all of this money is being used to short AMC or GME, a significant portion certainly is. When a squeeze happens, much of this borrowed capital will be called back, forcing institutions to repay at a massive scale. This $4.5 trillion figure is actually a minimum estimate, as it only includes data from regulated brokerage firms and excludes many others. In addition, brokerage firms have a history of reporting false or incomplete data, further understating the real numbers. Most of the margin debt is now being loaned by large banks, meaning taxpayers could ultimately be exposed if a bailout becomes necessary. Understanding these points makes it clear why AMC's situation is so unique and why short sellers are in such a precarious position. Despite claims from shorts that they've covered their positions, it's evident they have sunk hundreds of billions, if not trillions, into these trades. The mechanics of synthetic shares, rehypothecation, and enormous margin debt all converge to create a scenario that is unparalleled in market history. The pieces are all in place for a massive event, and the implications are staggering, not just for the institutions involved, but for the market as a whole.
Continuing from the dynamics of synthetic shares and regulatory inaction, it's important to examine how these factors are impacting the broader market and creating extreme pressure for short sellers. One of the clearest examples of this is what we've seen recently with firms like Genius Group. They filed a lawsuit against naked short selling, and immediately the number of shares available to borrow for them dropped to 0. This demonstrates just how powerful enforcement or even legal action can be when short sellers are forced to cover. The difference between Genius Group and AMC or GME, however, is scale. AMC and GME face this problem on a massive level due to the sheer volume of synthetic shares that have been created over the years. Even a smaller firm like Genius Group, with fewer synthetic shares, feels the squeeze, and that provides a window into what could happen on the scale of AMC and GME. When larger players face the same pressure, the consequences will be orders of magnitude greater, potentially triggering a historic market event. Another clear indicator of short seller desperation is the recent data on XRT, an ETF that has historically been used as a vehicle for shorting both AMC and GME. The borrow fee for XRT recently dropped from 2.56% to 1.78%, and now only 500 shares remain available to borrow. This is not a normal market situation. This is a sign that short sellers are scraping the bottom of the barrel, desperately searching for any shares they can lend or borrow. They're operating in what can be described as a short squeeze sauna, where every available resource is being used to maintain their positions and suppress stock prices. XRT and other ETFs are only a part of this larger strategy. Over the years, we've seen multiple methods being employed to suppress AMC and GME, from tokenizations to rehypothecation of shares, all designed to create synthetic liquidity while masking the actual scarcity of shares. These methods show how far short sellers are willing to go to maintain control, even in the face of growing market pressure. The financial mechanics behind this are staggering, particularly when you consider margin lending. According to FINRA data, as of March 31, 2024, margin loans totaled $784 billion. But that's just a fraction of the story.